All right, everyone. Thank you so much for joining us today, and all the great panelists that are out there. Um, so today I'm going to talk a little bit about how to outsmart the herd, use open interest for an unfair edge. It's a little bit different way to kind of trade than trend following, and I am obviously as a CMT here. I've been a chartered market technician, and again, my name is Matthew Timpane. Just so we have that out there. I'm a trend follower by nature, and it definitely is incorporated into the strategy. But sometimes there's little cues that we can use from open interest to give us this edge, right? So, just a quick bio on myself. Again, charter market technician since 2018. So I've been doing this as a CMT designation for whatever, 7 years now. But I've been trading now for about 17 years. Started out probably a lot like you all. I was a retail trader myself, right? Like we all kind of have to start somewhere. First found the itch a little bit in high school in the econ class, and then really kind of in college is where I started trading. And it was really kind of during the great financial crisis. So a little bit of baptism by fire there. But I was a portfolio manager for an RIA and a partner where I kind of got my way into the industry and worked my way up quickly. We sold the firm in 2018. I searched and searched and searched for a firm to join after that because the RIA that I was a part of was active management, and we sold to a firm that was a little bit more passive and they outsourced their portfolio management. So after like basically a nationwide search, I found Schaefer's Investment Research and I dove down the options market rabbit hole. So that is kind of my specialty now. I've been with them since 2018, so the same year that I got my CMT. They are based out of Cincinnati, Ohio, and it's a wonderful team over there. And they are actually celebrating, we are actually celebrating, I should say, our 44th anniversary this year. So we've been around doing this for 44 years, where you can't really say that about everybody else. Over 44 years, a lot of those people that have come and gone, we've stayed there. We've been a mainstay in the options research domain. So, it's a huge undertaking there. I do now work remote, so I also would love to thank the team over there. I went remote with having a child, and I probably don't thank them enough. It's a great opportunity to be able to see your child every single day. He's about 18 months now, and he's able to live by family. So I'm up in the northern woods of Minnesota right now, and so if I do for some reason cut out, I'll log right back in. We've had some kind of spotty internet over the last few days, but today it's been working great. So again, thank you to Schaefer's. We are celebrating 44 years, and we do actually have like a 44-year anniversary stock pick that is for from now until year end of our top picks. So that's something you can always check out on our website. Let's get going though. All right. So something I would love to do a full presentation on, but obviously it would be too much to or too little to do. What really is draws people to playing the markets, trading the markets, right? They want to pick stocks is what draws most traders into the markets, right? But risk management is what really separates a successful trader from those that are not going to make it. Like I said, I wish I could do a full presentation on this, but it just probably wouldn't be enough. It'd probably be like a 20, 30-minute one. We could go over some things like ATRs and certain indicators, right? But a whole hour would be tough. However, I want to just provide a healthy reminder before we get into open interest that we need to cut our losers and let our profits run, especially when trading options. Options traders, really we're battling not only price action, but we are battling time as well, on expiration. So, you're only going to be right 35 to 45% of the time. It's the typical options trader out there. And I know that sounds low because when you're a stock trader, you have the benefit of time, right? The only thing that you have that you lose is opportunity cost. Um, But when you do get those 45% or outlier years where you maybe do get 50% or 55% right, and I'm talking about long premium, I'm not talking about selling premium here. Selling premium, you definitely should have a higher win rate of around 80% at least. But when buying premium, you do get those outlier years, 45 to 50%. Those are going to be huge years for you because you're targeting at least a 3-to-1 risk reward ratio, if not more, right? Like sometimes 4-to-1, 5-to-1. Um, so for every 100% you risk, just for people that don't understand that, you should be targeting 300% winners, right? So if you're targeting, if you're looking at like a 50% loss, average loss, you really should be targeting, a bare minimum 100, but really you should be targeting 150%. So you got that 3-to-1. And you're not always going to hit those 300% winners either, right? You won't always hit them, but it's going to help you achieve at least a bare minimum of 2-to-1 ratio by letting these winners run. And then this takes advantage really of the power of convexity that options provides. And that's a real powerful thing uh, when you're trying to compound capital and using the power of options. And the reason why, I mean, we're in options too is just because we want to be able to help people grow accounts, right? It's hard to buy 100 shares of a lot of companies. So, we don't do things like out of the money, really. We're really more at the money, in the money options here. The proof is in the pudding. And then this is not to sell you on our service at all. This is really just to show you an example of why you need to cut your losses. So please don't use it as like a selling point. But it's just, as you can see, I've traded 101 long premium trades this year for our subscribers. The average loss is 66%, and I lose 58% of the time. Now, I do trade services where I risk 100%. There's certain programs that we do, and we risk 100% for like 300% winners. So I will have a slightly higher average loss than many swing traders that target 30 to 50% because I can't get out. It's just a week-long strategy that we do, and we're just going right into options expiration. But you can see that my average profit is 121% at about 42% of the time. So even though I'm not at the 300%, I'm not even at the 200%, you can see that I'm getting about 2-to-1 risk reward ratio there, and it's still a very profitable strategy with only a 41.5% win rate. And this has led to about a 1,200% cumulative return. And this is data from Monday. So I thought I spoke on Tuesday. So I put Monday's data in and just, I think it's at like 1,280 now on the cumulative. But if you want to look at it from like a portfolio perspective, that's about 13 and a half trades per month. These are swing trades, um, which if I calculate the return to mid-July is really like, you look at it like a back of the envelope, back of the napkin type of math here. It's like 162% or 160% type of portfolio return. So honestly, I do think I've underperformed, in this market. This market is ripping bull, and volatility traders and trend traders that can pivot quickly have really capitalized on this. So in personal accounts, I can tell you, this has been an absolute gift for people that are volatility and trend traders this year. And it just really kind of saying it as one thing, right? Like saying, hey, cut your losers and let your winners run. But I hope seeing the results can just change your mindset. If you're the type of person that takes profits early, sits hoping for losers to rebound back to even, to get out to get out of it, or to worse yet, buy more, right? You want to double down, like, okay, hit my stop loss, I'm going to double down on this. Please, please, please don't do that. The market is telling you you are wrong. So unless it's part of a strategy of pyramiding into a position that's a little bit longer term, cut those losers if you're trading quickly and just get out. So honor those stops at all costs. If you need further proof, 2022 was a pretty bad bear market for everybody. We all know this, and it's nothing to brag about. Like I said, I think I finished slightly positive that year, and it was like 4% on a portfolio basis. Nothing to write home about. But the reason why I was able to navigate that bear market and it was, I always honored my stops, and I did let my winners run until my strategy said the trend was over or I hit targets. And really, it's even best just to let those winners run until that trend is over. You get that signal. Now, that's just something I really wanted to emphasize here of why people aren't successful. They have a tendency just to take those profits when they see them and then hope on those losers. And you can't do that to be a successful trader. So now on to our feature presentation on open interest. So why not like a technical indicator, right? Like it's not that they're wrong. It's mathematically wrong or whatnot. I'm a CMT. I see validity in a lot of them, but the way in the way that they're constructed is accurate, right? Like, and they're as good as they can be. Um, However, you know, look at that bottom quote that I just put there. I know great analysts that are horrible traders and great traders that are horrible analysts. You have to ask yourself, why is that? Do they have a feel for the market that others don't? Maybe they, obviously they don't really use fundamental analysis because most traders, you know, they don't, it's kind of useless to a trader unless you're going longer term, right? You can kind of care less about the fundamentals. We're looking for what's working now. So why is it? Well, usually they have a feel for the tape by looking at, time and sales and level two data, so volume. But there is one way that you can also capture it, and it is still a lagging indicator by a day, but open interest, right? Open interest change. And it's just kind of telling you a lot of things that the other indicators are not, right? The ones that you can easily put on your charts. And it's not that I don't use them. I use moving averages. I look at MACDs and RSIs, and CMT. I mean, I know every single one of them out there. And I actually use something called the matrix, which kind of combines a lot of those lower level, MACD, RSIs. So it just tells me what other people are seeing, and I paint my candles with it. Um, so the truth is, I really adapted, like I said, from a longer term trend following strategy to trading options. And I've really kind of come to, I guess, have a disdain for a lot of those indicators because when trading options, you're a lot of the times you're kind of Johnny come lately. It'll work a lot better with, stock itself, but with options, you kind of need to be, trying to be pinpoint those entries and you're going to sometimes be pinpointing those exits as well. But really it's about not front running your drivers and pinpointing those entries when trading options because you can lose quick. And a lot of times you're going to get whipsawed then if you're front running those drivers. So MACD works great on high beta names. RSI crossovers work pretty good on signals when they're crossing up from oversold territory. But so if you're buying longer term, that's okay. But if you're going short term, these things don't really work that well. This is why I look at open interest, and you know, uh, I'm hoping that I can find a ton of confluence as well with the other indicators. Um, it'll tell me that other people will be joining in on the trade with me and help give me that volume that I need to see that trade play out, right? Or I can expect, people will eventually at least catch on to it. And we're going to go over that on some examples. Um, so on my charts, like I said, you're going to see moving averages. You're going to see the matrix painting on candles. Maybe not today's charts, but I can always throw them on if I want to, or if you guys want. But um, I'll do Fibonacci's. I do the conference here. I like Fibonacci's, but I like to use these all in coordination. They're rarely my main driver, right? Like they are part of my drivers. They're just rarely my main driver. 95% of the time they are not. In those cases that they are, I sometimes feel like I might have a little bit of lower hit ratio. So I should probably run the data on that though. But I really kind of focus on open interest has been really kind of been the best way for me to find actionable trades. So what is open interest by definition? It is the total number of outstanding contracts for options or futures that are not yet settled. Um, it also tells you the level of involvement from market participants. Other than volume that you can see intraday on time and sales and level two, it is a way to really kind of see how that tape is evolving throughout time. Um, so that is why I use it, and I use it in coordination with other things. So here's just a simple table that really explains the difference between open interest and volume. And I am doing this from a lower level to bring it to a higher, to show you how to trade because I don't know the participants that are on the call today. Some of you may be experienced, some of you may be beginners. So if you're more experienced, hopefully I don't lose you and we can just kind of get through this and then look at how I use it to trade. All right. Open interest, as we've noticed, it is the total amount of unsettled contracts, whereas the volume is the total number of contracts traded for the day. many of the contracts traded for the day could be open and closed. That will not add to open interest for those of you that are, really not familiar with this and how open interest works. If you day trade a contract, it will not be added to that day's open interest change. But when you swing trade options or, futures options, I guess you could say, uh, it will increase today's open interest, and say you sell it 3 days from now, it will decrease. Open interest can be used for gauging liquidity in the contract line, or rather, I guess specifically, the strike, if you're more familiar with that. I'll call it a line sometimes. So like the 210 strike, I'll say this is the 210 line. Um, and then the options market in general for that security, right? Like how liquid is it? And then volume gauges the daily trading activity. All right, how open interest changes. So this is just quick few bullets so you can understand. It increases when new contracts are created, as I said, decreases when contracts are closed, uh, offsetting positions, and then unchanged if a buyer and seller exchange existing contracts, right? So that open interest will remain the same. All right. If you do hear a little kid screaming in the background, that's the 18-month-old. Hopefully you don't though, but he did just wake up from a nap, it sounds like. All right. So interpreting or why is open interest foundational for options analysis? All right. It's a liquidity indicator. As I mentioned, high open interest means more participants are in a contract. This will help the bid asks, right? So it ensures tighter spreads, easier trade execution. So for example, say you're trading Apple, those bid asks when you're looking at the monies are usually, what, 2 pennies, so the bid might be 197, the ask might be 199, and the bid is 198 on the contract, 98. So um, and if it's not liquid, say total open interest in the security is only like 5,000, that's when you're going to start seeing like contracts that are having 50 cent wide, or sometimes even dollar wide bid ask spreads depending on the size of the security. So, say you're trading something like a service now, which you're paying 70, $50 a contract, which obviously multiply that times 100, so you're paying a lot for that contract, but you're going to see dollar wide spreads in there. Um, so that will tell you, like, hey, if it's got high open interest, you're going to keep those bid asks a lot tighter. And if they have low open interest, you can expect that bid ask to be a lot more sloppy, a lot more open, and you're going to really want to work the order. You're not going to be just hitting the market on those contracts at all. You're going to need to work it to get into that position, or you might not even want to trade it, to be honest, because a lot of the times those are the ones that are the most difficult to trade, because market makers can really kind of control that security with the low open interest there. Trading strategies. All right, that's what we'll be going over. Understanding how open interest helps gauge where the market's focus is, revealing popular strikes or expiration periods. So I have some great examples of that. And then at the end, if we still have extra time, we can throw some tickers out there. I got my laptop open that's connected to the VPN, so we can look at what I'm seeing and on open interest. And then market sentiment, rising OI paired with price movement can confirm trends, right? Whereas falling open interest may warn of reversals, and we'll go over that. Interpreting it. All right, so interpreting it is, you combine it with price movement for insights, like I just said. And so price up, open interest up is bullish confirmation. Price down, open interest down, or open interest up, bearish confirmation. Price up or down and open interest down, there's possible reversal or trend exhaustion that's underway. So you want to be careful of those ones, right? People are getting out, even though price might be going up. They're taking their profits, they're moving out of that position. It could end up producing, kind of a air pocket or a reversal type of move. So that trend could be getting exhausted. People are getting tired of it. So a lot of the times that's when retail traders get in, and that's one of my biggest goals is to prevent that. So just a quick way to interpret that if you don't know. Using open interest with volume, uptrend confirmation, rise in open interest, rise in volume. That's a robust bullish trend that you're seeing there. Downtrend, There's a rise as well in both open interest and volume, but you have a downtrend going on, right? So that's a robust bearish trend. You'll see these often persist and play out. And then the exhaustion is you're going to see falling open interest and falling volume, a weakening trend, possibly a turning point where you might want to be able to try to take the other side of that trade. And then a liquidation event. This is what every trader wants to get on the other side of, to be honest. You're going to see a fall in open interest, a rise in volume, and then positions really, this is when positions are being unwound. And it's sometimes just a short-term move, and you'll see some of the trades that I do where that will happen a lot. And they're short-term 5-day window type trades that I'm trading against. And again, I'm going to show you, obviously good examples, but there's losses in there too. So just for those of you that don't know how open interest kind of like change kind of log looks, like I just pulled this quickly for no particular reason. I just picked Apple. Everybody knows the name, and you can see how you can see the change, right? Plus 7,400 contracts here on this 210 put line for 725. And then you can see the previous dollar values here. So, you would look at like, oh, big line here, 20 million in premium on this call line here for 725, 215 call, right? They're still adding to that position. Apple is kind of trending sideways. So it's not the greatest example, but I wanted to show you exactly how one of these OI configurations works. And this is through unusual whales, but there's plenty out there. I mean, you guys can look it up. You can look up options flow. They all usually have open interest change as one of the things on their platform. I like unusual whales, but there's cheddar flow and there's a bunch of them. There's more experienced ones too, or more advanced ones too, like you can go to CBOE and they have like Trade Alert and Live Vol. But this is an easy one. This one's fairly cheap for everybody, so I figured I'd throw this one up there so you guys could see how you see the difference in change in the contracts. You can see where people have interest in them, right? So it was Apple. It wasn't a specific trade that I'm being in. All right, so how do I kind of use this, right, for trading, purposes here? And I'm going to try to hurry this along so we can get to some examples. Identifying support and resistance. I call them sometimes hidden levels, and they're sometimes not so hidden, right? Sometimes it's very well known, and you'll see that from the charts. But sometimes they're hidden levels. Like when things are out to fresh highs, you're gonna have like a hidden level. You don't have a resistance level, but there could be a hiding open interest level there that is going to act as a call wall. And one of two things happen, right? In those situations, you either break through it and run, or it works as support. So OI constant or open interest concentration. So large open interest concentration at specific strikes have, especially near expiration, often act as a support or resistance levels or a potential level that you're going to want to use as a pivot. So a sudden spike in that open interest it can really kind of signal that it's a critical price point, right? And you can just expect there's significant activity that's going to happen around this strike. I like to call them, like I said, peak calls and peak put levels. And I look at them on various ways. I look on them weeklies, obviously. So when I'm playing like a 5-day window, it's weeklies. But the big ones are front month, front 3 month, and then all expirations. And all expirations isn't as important to me. I really try to focus on front month and front 3 month, unless I'm trading like a year out, doing like an annual pick or something, which will cover that as well. But front month and front 3 month are the ones that I'm looking at for swing trades. So anything from like, 1 month to 2 to 3 months out. And then we try to aggregate it, and I'll show you that on a chart here. So, all right, breakouts in institutional activity. All right, pushing above the peak call level that coincides with price resistance can really be powerful. As it can produce what we like to call a gamma chase, right? With market participants buying new contracts, market makers are being forced to hedge those sold options by buying or selling in the direction of the price. So it can be a breakout to the upside or downside. Most of you would be more familiar with the upside, but you can get it on the downside too, and where you get this hedging activity that creates, huge movements, huge volatile movements for the underlying security. All right. Institutional moves. Usually high open interest changes at certain strikes may reflect the institutional positioning, providing clues to align your trades with bigger market players here. And I can send these slides over. So that's not a problem. I can send them to David, or you guys can reach out to us at Schaefer's. All right. So I'll take a look at that, and then I'll make sure to write that down. No problem. No problem at all. Um, so we want to be able to align with the bigger players in the market. And this is where it kind of comes in from like that, the longer term picks. And I have one example to show you that. It's two on the charts. Um, but I do annual picks for like the Money Show and then for Schaefer's. And I don't do a lot of these long picks anymore because I also do in-depth fundamental research that goes into it. But I still do them, for the 6 month pick and for the annual picks. I don't overly hate fundamental analysis either. Just because I'm a trader, don't think that I'm like, okay, I do use the term fundamental sometimes, but it's just more in jest and joking. The original firm I started with was a fundamental, deep value fundamental shop, and I overlaid trend following um, to help them not catch falling knives, basically. I wasn't even an option trader yet at that point. That's when I started learning about it. But so I don't hate fundamentals like a lot of people do. And really, I think fundamental shops are just trend followers anyways, right? Like revenue and EPS growth, they're just following trend. They're just a little bit late to the price movement. So that being said, longer term trades do provide insights through fundamentals and how there's kernels of information, right, that could tell you that something might be plaguing the company. It could be relatively soon, that could be over with. So this is where I get back to the options, right? So just some examples of four examples quick. Last few years I've done C Limited. There's this year's pick for Money Show and Schaefer's long-term pick. I think Dell was another one. That one's not doing as well, but C Limited is doing really great. Last year was TSM, so Taiwan Semiconductor. That was a foundry. Not everybody was really kind of catching on to the foundry play in AI, so that's the kernel of information for fundamentals. This year, that C Limited was the dollar. Everybody was like, "Wow, the dollar's super strong. This is going to hurt the company." And I said, "Well, take the contrarian idea of this. What happens if the dollar unwinds?" And that's what you've seen this year. And then the year before that was coming out of 2022, inflation scare. And my picks were MongoDB and so MDB and then Amazon. And that was inflation was like, hey, what happens if inflation cools off, right? You're going to see tech spend go back up in MongoDB. You're going to see the retail side in Amazon not be pressured like it was. So, but what is the real secret? It's open interest. It helps me produce high probability trades year long. Before I started incorporating open interest, it would be the success rate was a little bit lower, right? Like I had the fundamental research, I had the trend following and technicals, but I didn't have like, hey, where's these, market movers? Where are the big guys playing for this? And they can know things that I don't know, right? Like so I look for concentrations in open interest. All of the above trades, like I said, that I mentioned, or all the ones I talked about mentioned, have it. First, identify the concentration, which is almost always out of the money. And then look for large orders where they traded in sweeps, multi-sweeps, or block trades. These are traders you want to be betting with, not against. They may know things we don't, like hedge funds that are buying this, right? They have alternative data that we just don't have. It's super expensive to get, so they have data on like transactions, traffic monitoring, flights, patterns, and more. There's a lot more that they have that we don't have that they're disseminating and that they know, and that's why they're making these bets. When you see a large trader do that. Sometimes you're going to get lucky and you're going to see multiple concentrations. And something that I really love seeing is deep in the money puts sold by a large trader. So they see a floor where the price is going to be by that expiration. They want to capitalize on not only the move in price, but theta decay. So they might not be willing to buy those out of the money calls, or maybe they are selling those and buying those out of the money calls. We don't know who's exactly doing it, if it's the same person or multiple people. In the case of SE this year, I had both. It was nice. I had the 130 put seller into the fall, and then I had a large 140 call buyer and I think 145s too into year end, and I think even some Januaries. Then you can really kind of make this reasonable assessment of where the return that they're going to want kind of is minimally based on premium, and project kind of a price target. For SE, my price target was around 175, and it already hit 172.65 on the highs this year. And we'll show that on the chart at the end when I bring up the platform. So let's get through this. We got 30 minutes left. All right. So, so while, anticipating volatility and price maintenance, right? So when open interest builds rapidly around these strikes near expiration, on this now going back to shorter term, these levels may act as magnets, pulling underlying prices towards them because of hedging by institutions and the desire to manage their gamma exposure. One calculation of this is max pain, where most options expire worthless, and this is something I do use in my 5-day trading window. It can be critical to expiry and anticipate movement towards that level if it is within an appropriate distance. And I say that because if it is not within an appropriate distance, they've likely long hedged this away. So if, say, the price is at 200 and the max pain's at 165, and I have an example to show you on this, it's not probably going to get to 165. But you can still say, hey, okay, there's other reasons that it can still go lower. Maybe it's trading against a peak level, and we'll show you that. Um, I like to call max pain sometimes open interest balance as well. So OI balance. When you're looking at it from like a front 3-month time frame, sometimes you're going to find like support at that open interest balance level, and then you're still going to get that move higher up to like the peak call, or say it's bouncing up to that open interest balance level, but you have this peak put and it's in a downtrend. You're going to be able to trade that against that as well. So peak levels and max pain are something that we use in our trading. Things we don't use, and it's because it's just not our thing. Delta neutral gamma scalping, that's for some of those of you that know a little bit more. We don't do that. That's when open interest changes to they monitor open interest changes to manage and balance the risk and take advantage of volatility with dynamic positioning adjustments. We're simply just discretionary traders, and there is much better quants out there to do this, playing that game. That's something we can't really do on the same level. Um, and then seasonal cyclical trades, and I'd say, I mean, we don't do it, but we do kind of do this. We do follow seasonality, whether it's in stock price action, but we're not concentrated on the open interest patterns, right, in commodities, and that's really kind of where it is. But that's usually going to pop up anyways within the securities that we're trading because we dominantly trade equity positions. We don't trade futures or options on futures. And so we don't really dive that deep into the commodity section. Now, I will look into it if I'm seeing something happening in something that we're seeing already in the securities. So we'll be trading like the gold ETF. We'll be trading the miners, the energy companies. We're likely already going to see that open interest change in those names. So we don't really need to dive into the futures, but sometimes it's a good idea to kind of look at that as well. But that's not something that we dominantly focus on. But we do have an idea of like the seasonality and the cyclical trades. It's not our main focus. And a lot of the times I'll say this is seasonality works great. I love it. You see my writings. I talk about the July seasonality all the time. But I also always mention the risk. When seasonality doesn't play out, that's when you catch a lot of people off sides and you want to be on the other side of that trade. So just something to keep in mind as we go along. So this is how the price magnet kind of looks, to me, right? Like, and the open interest front 3-month, right? So this is an example of shop. It is a position I did put on. It's a little bit longer term, and so it's just if you can see here this 130 strike. We actually put this position on Monday, and we're going out to September in this one. And the real goal is, hey, this strike right here, we have some data that there's drift to the south before earnings. We think this 130 strike is going to act as a call wall here, so price isn't going to get through it. So we've got put exposure, and we've already seen a drift down lower now. So if you pull up shop on a chart that you're looking at home, it's already traded down to about 119. So the goal is hopefully that we're in the right position by earnings, and we can maybe let this position run through earnings, right? I want to see something like 50% on this. I think it's at like 25, 30% now because it moved back up the last few days off those lows to about 122, 123. So it's sitting around 25 to 30% profit. But if we can get to around 50%, we're going to let her run through earnings. And then my hope is that, hey, we get through this kind of OI balance here that's on the front 3 month is 120 because the September contracts is actually lower. I want to see them get through this peak put at 115, and then we can kind of roll all the way down. They'll see like a delta hedge down to this 105 strike, which is the last large put strike in the OI configuration here. So that's kind of just a play of how I'm looking at open interest. And you can do it on a week, you can do it on a front month. I like to look at it cumulatively through now. That was through September. I want to see how this plays out. All right, so max pain, as you can see, this is actually for the September strike. And like you said, I thought I was doing this presentation on Tuesday, so bear with me a little bit on some of this. I created it, as you can see, 718. But oh no, that's just it came from Friday's data because I did it on Monday, so Monday morning or Sunday night. But September's data here, and it probably hasn't changed much. The max pain is 112, and you can get this from maxpain.com, right? Everybody can go out there and get this. This is free information, so you can understand where it is, and you can click through all of the expirations to see how max pain is changing, where price might drift towards. And then so go out there and look at it. We have other tools internally, but I wanted to show something that you guys can all use. All right. Expiry dynamics. All right. And here's the thing is you put these trades on, things can change, right? Like it's not just set in stone. Like, hey, that 130 call wall is going to sit there forever. You could get the unwind and then it heads higher and I'm going to have to get out of the position. So I just want to make sure that you guys understand like this isn't static, right? Like, but this is ways to get into the trades. All right, so expiry dynamics, adapting to expiry dynamics. And I do have a great example of this. You're looking at shifts in this open interest leading up to an expiration. It can reveal rollover activity by institutions or sudden unwinding, which may trigger rapid price movements. And I have a great example I just traded not that long ago on this. It can also produce air pockets. So you'll see a lot of the times, coming into, just for example, July standard expiration last Friday, you'd see price kind of being held up to these levels. Maybe it's going sideways, maybe it moved up to a level, but you notice, hey, okay, into the weekend, it's just not really moving. They're pinning it to that strike. They're pinning it to that level, but maybe that's because of the OI dynamics, right? And there's a reason why they're holding it there. If for some reason a large amount of that open interest now falls off, say it was concentrated in that July expiration, on Monday or Tuesday, a lot of the times you're going to get these air pockets where you can get volatility. So you can concentrate on, you could put the trade on Friday and say, okay, well, there's no longer huge put support right underneath this price action. And it's all gone. And you might get a couple 2, 3 day play out of that before people either reposition in for put support, or you might get a longer play than you expect even. Maybe there's a big trend reversal. Standard option expiration dates have a tendency to produce big reversals in the market as well. You saw it a lot in 2022, especially in bear markets. It works really well. So that's something also to just kind of pay attention to. So you'll be able to get these air pocket moves. With this, you'll either need to kind of look at it and see it visually through your broker, through things like Unusual Whales or other options platforms out there, or you're going to need something that's a little more advanced screeners. Like we have some internal databases that will tell us, hey, there's going to be a lot of open interest falling off. I think Spot Gamma is one out there. They're pretty expensive, but there's going to be something like that. Trade Alert by CBOE or Live Vol. So you're going to need to have that. All right, let's look at some of the charts. I think. Oh, limitations first. Limitations. All right. What limitations does open interest bring, right? When looking at this, it does not indicate direction, bullish or bearish by itself. We want to have things lining up. So that is using other indicators. Nothing wrong with it. We want to have price movement or volume going with it, as I've showed before. Must be used with other indicators. Price action, volume, like I said, has to be used with it, but it's telling us levels of interest. of significant activity that could be happening at them. All right, so sudden changes may reflect that, positioning, hedging, or rolling type of in open interest. And it's still lags, right? It only lags a day, but it's still lags. So there is always that downside, but it does kind of give you the broad picture of market participants and the activity in the security. And I think it does a pretty good job of reflecting sentiment. All right. All right. Yep. Sorry, there's two sides there. All right. So quickly, I'm just going to go over this and then I'll put it back up at the end. But we do have a promotion going on today for a quick hit trader. It is for $9.95 for 1 year. It's typically 3,000 a year. We do 10 to 12 simple option buy alerts each month on this. The services that are in it is our overnight trader, where we take somewhere between a 50 and a 70 delta call, and we're looking for an overnight move. This can focus on things with open interest and trend that we're looking at. Hey, we think this is going to give you a good move. We'll get out of half on those trades if it's going in our direction, and then we'll let the rest kind of run to expiration. SWAT also, it's a little bit deeper in the money. Great trading type of service where it's like we offset it. Offset, we're not trading out of the money. We're offsetting like a stock replacement for people that maybe can't buy 100 shares of, bigger names. And these are typically about 2 week type of swing trades. And then we have our weekly volatility trader, which is a straddle, and we're just looking for volatility, cheap straddles that we're expecting a volatile move out of it, right? A lot of times these are also placed at big open interest levels. You could see that squeeze to the upside or downside, or you could see that rejection, right? And then you get that quick volatile move off those peak levels of open interest, and you're able to capitalize on it through cheap straddles. So we will go into the charts here so you guys can see the examples. Let me just pull this up. All right. And not all of them are going to have writing because I didn't save my charts from all the different publications that we do and real-time alerts. So that is my bad. But you can see this one was just from the other week. This is from In the Money, which is we're buying about 80 deltas here. So conservative, nothing huge. We're really not looking for 100% losers on this. We're hoping that buying that 80 delta, we're going to offset that to about, a 40% loss or a 50% loss on those ones that do lose. But here you can see like exactly what you kind of get in a lot of these services. We break it down. Price broke above the stage one pivot. These are technicals. Price took out the 200-day moving average, broke above year-to-date break even. It's the second largest Bitcoin reserve of tradable tickers. So we're giving these things. But here, let's highlight the open interest, right? So it's above peak call and could run the call stack. So here is where we entered, right? Peak call was at that 16 strike. As you can see, it's a beautiful pivot level right here. I had that drawn out for everybody. And we were kind of pulling back, right? We broke above, pulled back on this into Monday. So we got a great entry, that Monday entry, right into it, and then it took off. So we got the squeeze, and we thought right here, above peak call and could run the call stack. So the call stack went to the 20 strike. And it played out perfectly for us. They don't all do that, like you said, 40% win rate or 42% win rate, but played out, went straight to 20. And as you can see, as soon as we got above 20, so we got this actually, I think, went for like 350% on an 80 delta. Our people were already out, but if people wanted to hold on to it, or at least, it could be some of our subscribers would hold on to some of them. The peak up here was about 350. But we send an alert, hey, it's achieved 150%. You can get out of this, hit the price target that we're looking for, and you can see right down here, give you exactly what it is. Perfect. The OEZ, which is the optimal entry zone, that's where we think it's the best entry to get into it. But yeah, I mean, ran that call stack right up, and as you can see, it did not want to close. It did not want to, and that was Friday, right? Friday there. So did not want to close above that 20 strike call. As you can see, Monday, once that 20 strike call was gone, at peak call level, you got that huge move up to 2150, right? So once you got that huge move up to on Monday, it just gave it all up too. So that's what I'm talking about, the air pocket, right? Like it opened up an air pocket for that Monday trade. So you could have still played this, said, hey, okay, that 20 strike call wall's gone on Friday. I already made 150% on these ones or 200% or whatever, if you held all the way to 350, which I wouldn't think most people would. Think you at least take half off, right? But and then hold into Friday maybe where you get that 350. But you could say, okay, I'm going to roll out some of these profits here into next week, and you could get that huge move and capitalized on it, right? So that's one way to do it. Another way is this was recent, just last week. And this one is where I was talking about the max pain isn't as big it was a far away max pain. I think max pain was around 165, 162. I was not expecting for this stock to move to max pain. I didn't get my target on this, but it still ended up being a nice winner for triple digits. So we opened this right in here into the round 200 in the January 2025 earnings report. And I do have more data drivers here. I'm just going to pull them up on my laptop on the side. It was also trading around, trading right near the plus 20% year to date level. And then price was rejecting. You can see, price was kind of rejecting this 200 level right underneath it. That was peak call. And it did it for the last 2 days. So we entered on Monday and it went right up to it. So kind of scares you a little bit sometimes, but went right up to it. Uh, and then we thought, hey, we could get a possible unwind here. It's not going to want to stay at that 200 strike level. So we thought, hey, I know max pain's lower and it's out of reach, but even if I get a move down to, this 20-day and maybe it breaks below, maybe I can get an unwind. And I think my 300% target on this, because this was an at the money option, 200 strike put for July expiration. My at the money target would have been I think it was 182 and a half. So I needed a little bit more. I didn't quite get there, but it did finish up triple digits into expiration. So no favors the last 2 days, but sometimes that happens. All right. Next one, Okta. All right, Okta, a name. A lot of traders are going to look at this and they're going to go, why would you trade that? Broke below the 200-day moving average, clearly below the 20-day moving average, right? And you're like, oh, this kind of looks ugly. But there is some things here, right? You got this pivot level, you got these prior lows that did honor this 200-day. And something I don't actually have on the chart here, you actually have it's the 1 year, the 252-day moving average. And that was right around here as well. So it actually broke lower. And so I was like, oh, well, this position could be toast. So, I mean, happens to the best of us. And, but what was I seeing in Okta? All right. So I got the drivers here on the laptop. Let's just pull it up. Uh, I should have put these on the chart on all of them for you, but kind of ran out of time on that. But max pain was $100. So you see that was on the chart. Max pain is $100 there. So my thoughts initially were, hey, we can maybe get this move off of this level and get back to that max pain, a push higher. Now in Okta, that's not that dramatic, right? It's 10%, but Okta is a pretty volatile trading stock. And Okta and price was into the negative gamma territory and near the end of a put stack. The put stack went down to about 89. So as you can see, my entry wasn't so bad. I mean, it was around 90, 91. And it's just part of the service. So, I mean, 89, you kind of see it almost went down to 89 the end of that put stack. And then that's where you saw the bounce, right? The wicks. So I honestly, like I said, thought it was kind of toast. And there was, but there was a large concentration of put buyers within 10 days too, right? That's another thing that we look at is the 10-day put call volume ratio. And we look only at people that are buying on the ask. We don't actually look at it from a naive way, where you're going to get that from every other place can give you put call ratios, but they're all just very generic and naive. We're looking at on the ask people that we think are buying options. And a lot of times we're going to fade that with contrarian moves. So that was another reason. And then options were super cheap in this actually. They were priced in the eighth percentile on a 52-week basis. And I should say that about the last one, two AMAT. Super cheap. They're actually in the 0 percentile. So they're dirty cheap. Sometimes they're cheap for a reason, but want to have cheap options because if you get an implied vol move, that's in your favor then. But lo and behold, we get a move into Friday here. and it ends up being a triple digit winner. So I mean, uh, looks horrible, but we're playing the open interest, and I'm saying, hey, this could be the fake out move into the pivot, retakes that 200 day, and maybe get max pain. I didn't get it, but we still got a triple digit winner out of this, and that's what we're looking for. We're looking for those risk rewards, and we're looking at trying to have an edge where other people aren't seeing it. A lot of people are going to be getting on the wrong side of this trade, trying to short below this 200-day moving average. Upstart. This is one that has a volume pocket. I played it in more of a swing position, like a 2, 3 month conservative, like 60 delta or something, or 55 delta. But Upstart, I got these drivers here too. All right, so Upstart, all right, it was breaking above the June closing highs, right? So you're breaking out of this little kind of basing zone, this little pennant. Some people might say, well, it's kind of a flag that's a bear flag, but you broke above. All right, it's bullish. Most patterns are about 50-50. So I don't look at that the same way. I'm not like, okay, this is bearish, this is bullish. A lot of bull flags fail too. So it bounced near peak put, which is at $50 that week. And we got above this, this pivot. Once we got above that pivot, what I saw was there was an open interest change coming up in the next week. 65 strike was going to be gone. So I was like, okay, let's get into this. So 65 strike, as you can see here, it held, right? So there it is. It bumped up against it. You got price up to about $66, but it closed the week below that 65 strike call level, which was a call wall for resistance. But as soon as that went away, that one that was for the very next week, that's when we got this move higher in Upstart. And it's highly shorted. There's a lot of things that were going on for this for drivers, but that's how you can use open interest. I'm like, okay, I might not get above 65 next week, but once that dissipates, they can take this price and move it higher, bring it back to these prior highs over here. And then we got out somewhere probably, I think it was around July, somewhere around here. So we didn't get the ups and downs, but and we got out here. And this was only 100%. Like I said, I was doing it in a much more conservative type of strategy. Etsy. So this is back in May. Played this right into the peak here. As you can see here, I was looking at this kind of pivot level all the way over here. You had support, became resistance, and now we're playing against the 65 level. And since I only got 7 minutes left, I'm going to try to hurry up through this. All right, Etsy. Okay, I don't have Etsy on there, but I know there was a concentration of 66 and 65 calls. So that's why I played it up here. So we got that pivot move kind of into the pivot. We saw a large call wall. My expectation was, hey, we might get a move up to 66, and then we're going to probably get a rejection. It played out beautifully. This is one of those ones that we were really happy. This was in the money too, so it was only like 150% winner. We're playing 80 deltas, pretty conservative. So even if it like moved up to like 66, I think we are in like the 67 deltas or 67 strike or 68 strike. So even if it kind of stuck up here and pinned to the 65, 66 area, you weren't going to take 100% loss on it. And that's part of the strategy that when I'm looking at that is like, okay, hey, they can't take a full loss if it pins. But if we do get the move, we're going to get that big move. Procter and Gamble. All right, another one. Looks horrible, right? This was one that we played, I think it was back in May. Let's see if I can find, yep, here it is. Peak put resided at the 155 strike, right? So I played it right here. Again, looks horrible, but we have these prior lows. Let's just kind of look at it. And they're going back even further, right? You got all these wicks, prior lows, prior lows. So you're trading in these prior lows. It's a level. It's very defined. I actually looked at it again right here. Luckily, I didn't take it, but 155 strike put, took the trade, got a really bad entry actually on it. The entry because we take it for half. I mean, it was huge candle. So I was going for 300% on this. You can see here into Friday. That's a 5-day trade. I got up to about 163. If it wasn't for the bad entry, because we take a VWAP, we don't say, hey, this is the lowest low. We take a VWAP for like 4 hours on this, and this is where we say, okay, this is where our subscribers got in, and we take the average of it so that we're honest. And then it kind of went to where I thought it was going to go. Thought it was going to go the 50-day. It was about a day late on that. Got there Monday, but Could have been close to that 300% if it wasn't such a bad entry. But again, looks horrible. Area of interest. Exactly. All right. And let's see. Next one. Baba. This is back in March. So we'll go over it quickly because we only have a few minutes left. But again, there was 145 and 146 concentration of calls up here. This is where we entered. It was almost another, uh-oh, I'm going to get a squeeze. Came back to me, opened, went lower, and we kind of broke through that 20-day, got another flush out. That week, we ended up with 325% on that one. And then SE. So this is the longer term one. I want to make sure that you guys see all this. We got 4 minutes left. Uh, this is where I was looking at big out of the money call buyer 140 strike, deep in the money put seller 130. This is where the annual picks go out, right? December 31st, January 2nd, right around here. Um, it honestly didn't really look that great on the daily chart, right? Just broke below the 50-day. I did all the work over here, so coming into it, it's like, oh, the 50 days right there. Yeah, came down, faked me out. I was like, oh boy, here we go. It's going to go down to 80s. But I do put in like, hey, buy down to this level, things like that I'm seeing. And I think that level for me was buy down to about this 100 in this gap area, 100 and then to about 95. Super solid trade. You want to see it above that. So you can see got there. Great entry for the long-term picks too. But did come back. I mean, hey, we broke through it in April. Looked horrible on that tariff tantrum. But then where do we get the move up to? Like I said, 172 and a half. So long-term buyers were still able to get this, looking at those open interest configurations, was able to tell me, hey, this is where they see it longer term. And then finally, it's a trade that we're in. We got 3 minutes. And I got the drivers here. And there's more drivers for like the SE. You can look it up on Money Show. I mean, there's a whole page right up on that one. All right, so we're buying, and I didn't put the buy point. Held the 50-day right down here. Let's see, it was Monday the 30th. So right here on this trend line breakout, we bought it, and this trend line is really from an hourly chart, so that's why it looks so steep. Sorry, voice is getting a little dead here at the end, but I was seeing 14 and 15 strike puts being bought during that week. I thought it could set up a floor where price can, then run overhead call strikes into the August expiration into the 22 strike. And, obviously it's a high short interest name. It's a quantum name. Price held near this gap level on Friday. I thought it was very important that it held that. And I thought like, hey, they're going to be putting in this put support here and we get a move. Yes, you have the 20-day moving average behind you. And it's been rocky, right? Like it hasn't been perfect, but we've come back up. And I think one of these days it was like 175. I'm really kind of looking like, hey, okay, maybe if we give up this level, this 19 and a half level, two times, I might just say, hey, let's just take this triple digit winner here, 100%. Because we almost lost it already, but came down, bounced that 20-day moving average. But my goals right now is like, hey, let's see if we can get this out and up. It broke back above recently. We're getting a bit of an inside kind of here today, but I think we can still move a little bit higher into August expiration, maybe within a few days. But that's how I'm looking at open interest. So thank you for joining me today. Let's see if I can pull up this. No, as you can see, a team message. Let's see if I can pull up this for you guys one last time. The Quick Hit Trader. If you want to trade alongside of us, give us a call, and we'll get you into the service. Again, happy to join all of you. Trade them well. Stay safe out there, and just honor your stops. Let those winners run until the strategy tells you to get out. Thank you, everyone.